Term 79, S&Ls Savings and Loan Associations. Savings and loan associations, also known as thrifts, savings banks, or thrift institutions, were historically financial institutions that focused on providing 1. Savings accounts. These accounts offered individuals a safe place to deposit their money and earn interest. 2. Residential mortgages. S&Ls played a major role in financing homeownership by providing loans to people to purchase houses. Term 80, commercial banks. Commercial banks are for-profit financial institutions that provide a variety of financial services to businesses, consumers, and institutions. They play a crucial role in the economy by 1. Accepting deposits. They offer savings accounts, checking accounts, and other deposit products where people and businesses can keep their money safe and earn interest. 2. Making loans. They use deposited funds to provide loans to businesses for various purposes, such as equipment purchases, working capital, and real estate acquisition. They may also offer loans to individuals, like auto loans or personal loans. 3. Other services. Many commercial banks offer additional services such as cash management solutions, international trade finance, and investment products. Term 81, insurance companies. Insurance companies are businesses that provide financial protection against potential losses. They do this by pooling risk from a large group of people, policyholders, and using the collected premiums to pay for covered losses suffered by a smaller number of policyholders. Insurance companies have large pools of capital from premiums paid by policyholders. They often seek investment opportunities for this capital, and big industrial loans can be an attractive option for them. These loans offer potentially high returns, but also come with higher risk compared to many other investment options. Insurance companies can manage this risk by carefully assessing the borrower's creditworthiness and structuring the loan terms appropriately. Term 81, insurance companies. Term 82, Fannie Mae. Fannie Mae, officially known as the Federal National Mortgage Association, is a government-sponsored enterprise, GSE, in the United States housing finance system. It plays a critical role in ensuring liquidity and affordability in the mortgage market. Core functions of Fannie Mae. 1. Purchases mortgages. Fannie Mae doesn't originate mortgages directly. Instead, it purchases mortgages from lenders, primarily those originated for conforming loans which adhere to Fannie Mae's underwriting guidelines. 2. Provides liquidity. By buying mortgages from lenders, Fannie Mae injects money back into the lending system, allowing banks and other lenders to originate more mortgages. This increased liquidity helps keep interest rates lower for borrowers. 3. Guarantees securities. Fannie Mae packages these purchased mortgages into mortgage-backed securities, MBS, and guarantees timely principal and interest payments to investors who buy these securities. This makes MBS investments more attractive, further increasing liquidity in the mortgage market. 4. Supports affordable housing. Fannie Mae offers various programs to promote affordable housing, such as those geared towards first-time homebuyers or low and moderate-income borrowers. Benefits of Fannie Mae. 1. Lower mortgage rates. By increasing liquidity, Fannie Mae helps keep mortgage rates lower for borrowers compared to a scenario without its involvement. 2. More affordable housing options. Programs offered by Fannie Mae can make homeownership more accessible to a wider range of people. 3. Stability in the housing market. Fannie Mae's presence contributes to a more stable housing market by ensuring a steady flow of funds for mortgage lending. Term 83, primary mortgage lenders. Primary mortgage lenders are the initial source of funds for mortgages. They are the institutions that you deal with directly when applying for a home loan. These lenders originate the loan, meaning they assess your eligibility, collect your application materials, underwrite the loan, determine your risk as a borrower, and ultimately decide whether to approve or deny your application. Types of primary mortgage lenders: banks, credit unions, mortgage companies. Term 84, investors in government securities. Investors in government securities are a diverse group of individuals and institutions that purchase debt obligations issued by governments. These government securities, often referred to as government bonds, treasuries, or sovereign debt, are essentially IOUs issued by governments to raise money. Term 85, secondary mortgage lenders. Secondary mortgage lenders aren't directly involved in originating loans to borrowers. Instead, they purchase existing mortgages from primary lenders like banks, credit unions, or mortgage companies. This creates a secondary market for mortgages and plays a crucial role in keeping the housing market liquid. Function of secondary mortgage lenders. 1. Acquire mortgages. They buy mortgages from primary lenders, freeing up capital for those lenders to originate new loans. This helps maintain a steady flow of funds in the mortgage market. 2. Package loans. Secondary mortgage lenders often bundle purchased mortgages into mortgage-backed securities, MBS. These MBS are essentially financial instruments that pool the cash flow from multiple mortgages. 3. Sell MBS to investors. They sell these MBS to investors on the secondary market. Investors buy MBS seeking a return on their investment in the form of interest payments derived from the underlying mortgages. Term 86, front-end ratio for a loan. The front-end ratio, also sometimes called the housing ratio or mortgage-to-income ratio, is a metric used by lenders to assess a borrower's ability to afford their monthly housing expenses. It essentially measures what percentage of your gross monthly income is dedicated to housing costs. The front-end ratio is calculated by dividing your total monthly housing expense by your gross monthly income before taxes and deductions. Here's the formula. Front-end ratio equals total monthly housing expense, gross monthly income. Term 87, debt-to-income ratio, DTI. The debt-to-income ratio, DTI, is a crucial metric used by lenders to assess a borrower's ability to manage their existing debt obligations in relation to their income. It essentially indicates how much of your gross monthly income, your income before taxes and deductions, goes towards paying off your debts. The DTI ratio is calculated by dividing your total monthly debt payments by your gross monthly income. Here's the formula. DTI ratio equals total monthly debt payments, gross monthly income. Term 88, principal, interest, taxes, and insurance, PITI. PITI stands for principal, interest, taxes, and insurance. It represents the four main components that make up your monthly mortgage payment. Understanding PITI is essential for understanding the true cost of your mortgage payment. It goes beyond just the headline interest rate and gives you a clearer picture of your monthly financial obligation. By factoring in the total PITI payment, you can create a realistic budget for your housing expenses.